promote mutual funds as mutual fund sahi hai. And that's absolutely right. Mutual fund sahi hai indeed. But today, we are going to talk about a certain subset of that. We're going to talk about systematic investment plan. Now, SIPs have gotten really famous in the last 3-4 years. If I go back 3.5 years back, the monthly equity SIP in the mutual fund markets used to be close to 6.5-7,000 crores. Today, it is close to 19,300 crores. In fact, this is the second straight month jahan pe where the monthly equity SIP figure has breached 19,000 crores. So very soon, I think this will breach 20,000 crores. It will breach 24,000 crores as well. So this is a very huge figure because that's almost $3 billion a month. So yearly, that's approximately 35-37 billion dollars, right? So this is a very huge number. It basically tells you that Indian investors have come of age. Indian investors have realized the importance of SIPs. A lot of new investors, and when I say a lot of investors, I mean crores of new investors have come into the market. Tens of lakhs of these such new investors uh, have started investing in the market through the SIP route. So I talk a lot to I talk to a lot of new investors, and sometimes I get a lot of doubts. There are a lot of myths associated around SIPs, right? So number one, we're going to understand what SIP actually is. Why do I and a lot of other people who propagate wealth creation talk about SIPs, and why do they say that SIPs are a great way to invest in the equity markets? Number three, I'm going to debunk a lot of myths. And number four would be will be a quite lengthy Q&A wherein I'll try to take a lot of your questions. So last time my presentation was lengthy indeed, but this time I have tried to divide it 50-50, where 50% of the time I'll allocate towards my presentation, and the other 50% I will try to take your question so that a maximum number of people get their answers. So number one, why there is a need to actually invest in the markets, right? If you see people who were born in the uh, 60s, 70s, 80s, right? They were very comfortable with their FDs. They were very comfortable with their LIC plans. But uh, those plans don't really work in today's world, right? Because number one, interest rates are not high as they used to be. Number two, people have come to know that LIC plans and other plans will give you low single digit returns at the best, right? So this safety tag has actually gone out of the window these days. There used to be a time when people used to give a lot of weightage to safety over the returns, but then in today's world where inflation is high, where lifestyle expenses are high, people have realized that LIC, FD are not really going to cut it for you. So of course, the number one reason for you to start investing is inflation, right? So assuming that your monthly expenses today are rupees 50,000, right? In the next 5 years, just taking the current 7-8% inflation into account, right? Uh, so in this illustration, they have taken 6%, but we should ideally take 7-8% because inflation has been ranging in that kind of a band. So 50,000 rupees today monthly expenses, 5 years down the line, to spend the same amount of money or to get the same 50,000 rupees of value from the various things that you spend on, you have to spend 67,000 rupees. 10 years down the line, it would be 89,000 rupees. 15 years down the line, it would be 1.2 lakh rupees, right? So even if you assume that you have an inflation rate of 6%, it means that if today you're spending 50,000, 12 years down the line, you have to spend 1 lakh to get the same value of rupees 50,000, right? And on the other end, we have the purchasing power. It's again the same one and the same thing. The first diagram basically shows you how much more you have to spend to get the same value. And on the right hand side, it basically shows you if you have 1 lakh rupees today, it will be approximately 55,000 rupees in the next 10 years, right? Again, assuming a 6% inflation rate. So this is your first motivation to invest in life, because if you put your money in a FD or a savings account or LIC, inflation will make sure that your money is degrowing 3, 4, 5% every year, right? So again, in those investments, you are basically halving your money. You're basically cutting half of the money spending power in the next 10, 12 years. So these are the historical inflation rates in India. So there's a very famous book called The Art of War. So it basically says that, if you know your enemy, half the battle is already won, right? So this is your enemy. Sorry to use that word, but it is what it is. Inflation or mehengai, as we call it, is your enemy. And how do you actually beat this enemy? By investing, like I just said, right? So you can just see that there have been some years where the inflation has gone as high as 12, 13% as well. And on an average, India inflation has been 6 to 8%, right? So there you have it. So again, this infographic basically tells you that, if someone is planning a wedding worth 10 lakh rupees, right? Uh, Say in the next 15 years, he has to save 24 lakhs, right? If someone is planning for retirement, worth 2 crores, 35 years from now, he has to save 15 and a half crore rupees. Same for the house. Today, if the house is worth 75 lakhs and in the next 10 years you want to save for it, you don't have to save 75 lakhs, you have to save 1.34 crores. Again, all of this is calculated using a 6% inflation rate. So how does SIP actually help you in all of this? Now, see, the thing is, 9 to 5. See, we live in a very competitive country. We live in India, right, where majority of the population is young. I'm sure a lot of you must have joined from Mumbai, and I was also in Mumbai, right? So when you get down from the local stations, you would see thousands of people going to their workplaces, and competition is not competition is visible the most in Mumbai, because you see in front of your eyes that, if I don't perform or if I don't hustle hard, there are thousands of people to replace me, right? So number one, 9 to 5 jobs itself have become so demanding. uh, when you do your job properly, when you do a 9 to 5 job properly, it makes sure that you don't have any other time left, right? So it's not as if you can do a 9 to 5 job, you can research, you can find out good companies, you can find out good mutual funds, and then invest on your own. That is not possible at all, because you have to take care you have to take care of your job, you have to travel, you have to rest. So weekend is the only time when you get time for yourself, right? And I'm sure that most of us would not want to spend that time also on working or doing research, right? So how does SIP actually help you? A mutual fund is a pool of investments, right? So there are thousands of mutual funds in India today. As per your risk appetite, as per your time horizon, you can select a mutual fund. Now, why do we actually say SIP? Because see, whenever we invest in the markets, the first question that we always get is that, is this a good time to invest? Sensex is at 75,000. So isn't it overpriced? Which kind of when should I invest? Which day should I invest? Which month should I invest? Right? So, SIP actually solves all of these problems for you, right? So number one, SIP. So SIP stands for systematic investment plan, right? So SIP is a product or a tool which makes sure that you invest every month until you cancel it into that particular mutual fund. Now, number one, what it does is that it instills a discipline into you, because you know that, okay, every month. So, for example, every month my 30,000 rupees SIP is getting cut. So I don't have to log into my net banking and then debit that 30,000 rupees, right? It will automatically go. But the number two advantage is that there is no timing problem with it. I don't have to manually think or automatically think that मुझे कोई दिमाग नहीं लगाना है कि okay, now the market is at this level, I will invest at this level. So SIP takes care of all of it. When the markets are at top, your SIP will still get cut. When markets are at the bottom, your SIP will still get cut. So you don't have to put in your hard work, right? So we have a very famous saying in the market that, instead of timing the market, make sure that you spend time in the market. See, when Sensex had reached 35,000, people were saying it was overvalued. When Sensex reached 45,000, people were saying it was overvalued. Yesterday, Sensex reached its all-time high at 75,000, and people are still saying it's expensive. So SIP makes sure that you don't have to answer all of these questions, because when the market is on an up move, your SIP will get cut. When the market is on a downward move, SIP will get cut. Now you will tell me that, isn't that a bad thing? Because when the markets are overvalued, the markets will fall down. So it's very simple. SIPs may there are two scenarios. Number one, the market is rising, which means that the units, the SIPs that you have already bought, they are in profit. And number two advantage is that when the market falls, you get more units. Now, assuming that I invest 100 rupees every month in SIP, right? And assuming that the net asset value or the unit value of a mutual fund is 100 rupees. So assuming in April 2024, I get 1 unit of that mutual fund. Uh, Assume 3 months down the line, market crashes by 50%. Okay, this is a black swan kind of a scenario, but just for the sake of explanation. So then what happens is that for the same 100 rupees SIP that I'm doing, I get 2 units, right? So when the market goes up, you're in profit, and when the market goes down, you get to buy more units. So I don't think any other instrument actually gives you that advantage where in both the scenarios you end up winning as an investor, right? So this is a very good illustration that tells you that SIP is this one-stop solution to all of your problems. You don't have to time, you don't have to decide the day, you don't have to be disciplined yourself. You just have to go to your net banking and put that biller so that every month your SIP is getting cut. So again, this is an example of what I was just alluding to earlier. Uh, for example, if someone is doing an SIP for say 6 months, of course, we don't recommend doing SIP for 6 months. It should be minimum of 7 to 10 years. But just for the sake of simplicity, we have just shown 6 months. So over here, you can see that the total investment in this 6 months is 60,000 rupees. The total units that you have bought are close to 5,920. So the average NAV during that time was 10.2. But since you invested even during the downfalls, right, your average NAV is 10.1, right? So this is the magic of SIP. Over here, you did not do any timing. Your SIP was automatically going every month, and still you ended up getting a lower price than the market. So this is a diagram. So if you would have attended my earlier session as well, this is a diagram that I usually love to show people because over the past 20 years, Nifty has given you a CAGR of 15%, which basically means that over the long run, the Nifty 50's return every year has been close to 15%. So it means every 4.5 years, you double your money, right? So, and let's not just look at it as a relative kind of a percentage. You can compare it to, say, US equity, you can compare it to gold, you can compare it to real estate, and you can compare it to debt. So when you look at the debt and the real estate returns, right, this is at par with inflation. So this is one of the reason why. So two conclusions come from here. Number one, if you have to beat inflation, you have to be in equity. That's point number one. And point number two, India has done much, much, much better than the other global markets and the other asset classes as well. So, this is a very beautiful diagram because, Nifty has basically multiplied your wealth by 78 times in the last 33, 34 years, right? So, the return is just 14.5% every year. But when you actually look at it from a very long-term time frame, right? So, you would have created really good money. So let me just quickly touch upon India, right? So the biggest quantitative data point that I told you was, India has performed better vis-a-vis other asset classes, and it has also performed well when compared to other global equity markets. Now, when you talk about multi-baggers, right, India has produced almost 100 multi-baggers in the decade ending 2021. So this has been the highest anywhere in the world. And there's a reason for it. India is performing very well. The last 1 decade for us was very good. We had a stable government. We had a very pro-business, pro-market kind of a government. A lot of visible changes happened on the ground. When I talk about the economy, when I talk about the financial markets, when I talk about the country as a whole, right? So we have gotten a global recognition as well. A lot of good things have happened, right? So, and of course, the result is in front of you. Almost 100 multi-baggers have actually been churned out of the markets. So when you talk about Nasdaq, it's just 10%. When you talk about S&P 500, it's just 7%, right? So again, a data point to just show you that India has done very well. So why has India done very well? It's a multitude of factors. I'll just quickly run you through it. Uh, Number one, India's contribution to world GDP has gone up from, say, 2.7% in 2000 to 8%, around 5.5%, 5.3% this year. India, the time taken for India to add $1 trillion to its economy uh, is becoming faster and faster, right? We have had a lot of reforms in the economy. When I talk about GST, I talk about bankruptcy laws, I talk about the digital infrastructure that is getting built. I can talk about the physical infrastructure that is getting built. A lot of FII, FDI flows are coming in. Indian markets are getting added to two global indices as well, right? So that's also very big news for India. Yeah, so I'm not sure whether how many of you would be able to zoom in and see this chart, but then it basically tells you the year-wise SIP returns and what kind of a maximum, minimum, and average return that you can expect given your time frame. So assuming you have so let me just dictate it for you so that people who are not able to zoom in can also understand this diagram better because it's very important. Uh, so assuming you have a 3-year view on the market, so you only invest via SIPs for 3 years. So in that case, your average return is 16%, but the maximum return that you can get in this 3 years is 54%, and the minimum return that you can get is minus 22%. So it can very well happen that if you do SIPs for 3 years, you may end up making minus 16%, or you can end up making 54%, right? So these are very divergent odds, right? Because whenever you're investing, you're making sure that you want your capital back and some return back, right? So let's go to 7 years now, right? So when you invest in SIPs for 7 years, your average return is 15%, your maximum return is 40%, and your minimum return is 0%. So this is a very good outcome because at the max, you know that, okay, chalo, my capital will be as it is. My capital is going to come back to me. Now, when you move to say 15 years or you say move to 24 years, right? So in 24 years, the best part is your average, your maximum, and your minimum is the same, right? It's around 14 and a half, 15%. So the purpose of this diagram is to show you that, make sure that whenever you're investing in SIPs, please keep it for at least 7 to 10 years, or if you even keep it for higher, nothing like it. And I will talk about a few examples going ahead as well, where people have made 100x, 200x, and 300x as well in their SIPs, right? So very good outcome. So the lesson from this slide is to invest in equity SIPs for at least 7 to 10 years. So again, what I said earlier, right? The longer the time frame you have, lower the odds of negative returns. So if you're investing for one day, there's a 50% chance that you'll get a negative return. If you're investing for 6 months, there's a 31% chance that you'll get a negative return. If you're investing for 5 years, 7 years, or 10 years, there's almost a 0% chance that you'll get a negative return. So just inverting the same diagram, longer the time frame, higher the chances of a positive return. So if you go back, if you will see here that 6 months, there's a 31% chance of a negative return. If you flip it, you can see that you have a 48% chance of a positive return, right? So it's 50-50 almost, right? Now, when you have a 7-year, 10-year view, there's almost a 100% chance that you're going to get positive returns on your money, right? So synthesizing or just summing up these three slides, uh, don't have a shorter term time frame in the equity markets, have a longer term time frame in the equity markets, because it will ensure that you get positive returns. So again, this is one of the biggest myths in the market, that you have to choose uh, the worst possible day in the markets and start from that, right? So it's nothing like that. So if you see from 1996 to March 2023, if you invested during the worst day of the month, your CAGR was 13.9%. If you invested during the best day of the month, your CAGR was 14.4%. And if you just left out everything and you just selected a random date, say 10th of every month or 15th of every month, your CAGR was 14.1%, right? So the point of this slide is to educate people that don't spend your valuable time trying to time the market, trying to find out the worst possible day or worst possible level of the market. Just pick a random date and start your SIPs, right? Because in the end, it will not matter at all. Your CAGR will be just off by 0.2, 0.1, 0.2%. And honestly, trying to find out that possible worst day is not worth it. you might as well spend that valuable time researching some good mutual funds or good companies. So like I said, this is again a historical study which says that, you choose any day in the end does not matter. You choose the first of any month, you choose the 12th of any month, you choose the 18th of any month, right? The difference is marginal. It's not worth the effort. So this is the last 26-year data. Again, let me just read it out for you so that it's much better. So if you had invested in a SIP for the last 26 years for S&P, BSE, Sensex, if you invested on the first of every month, your CAGR was 15.74%. If you invested on the 18th, your CAGR was 15.71%. If you invested on the 15th, it was 15.71%. And take any date, the maximum and the minimum return is the same. I think the minimum would be 15.65 and the maximum would be 15.74%. Right? So it does not matter. As simple as that. So how much time to invest for? Like I said, a minimum 10 years. The slide says the same. And one more very important thing is to tell everyone on this webinar is that to never panic, right? So this slide basically tells you that what happens if you had stopped your SIPs during a bad phase, right? Let me just yeah. So it basically tells you that there were from September 2001 to say March 2018, there were 3 bad phases in the market, right? So if you had stopped your SIPs during the bad phases, your return would have been off by 3-4%, as simple as that. So, bad times, in fact, are a very good time for you as an investor, right? Because it ensures that, you get more units of your particular mutual fund. It's like an Amazon sale, as simple as that, right? So whenever there is an Amazon sale, right, you go to the platform, you buy a lot of stuff. So it's very ironical that when the same thing happens in the stock market, people try to run away. The market is giving you a discount and you should make sure to benefit or to monetize on that discount, right? In fact, we tell a lot of our clients to buy more during falls, right? So these are some of the calculations that we have done. If you want to reach, say, a 10 crore corpus at the age of 60, right? And assuming a 12% kind of a return every year, which is very realistic, honestly, because as we have seen before, Nifty itself has given you 14 to 15% returns over the past 20-25 years. So if you start investing at the age of 25, your monthly SIP required is 15,000 rupees to reach a 10 crore corpus. If you delay it and start at the age of 30, your SIP required is almost 28,000, which is like 2 times almost. If you delay it further and you start at the age of 40, the monthly SIP required is more than 6 times at 1 lakh rupees, right? So, whenever we talk about the compound interest formula, right? So people tend to focus a lot on the R, which is the rate of interest or the returns that you can get from the market. People totally ignore the T or the time aspect of it. But in reality, you take any big investor, domestic in the domestic markets or globally, right? So Warren Buffett bought his first stock at the age of 16. He became a billionaire, I think, at the age of 54. And today, when he's 90, and he got his first, and he became, his net worth touched $10 billion when he was 67. And today, at the age of 96, 97, he's worth 115 billion dollars. So you get my point, right? It took him almost 42 years to get his first $1 billion. But the next 35, 37 years, he multiplied that $1 billion by 110 times. So, you should start as early as possible, make sure that you get that discipline in. I still remember when I started working, when I had my first job in 2015, my monthly salary was 15,000 rupees. And I used to invest the majority of it. People told me that, why are you investing this small amount of, say, 10,000 rupees or 50,000 rupees in the markets? What difference is it's going to make you, right? But it's not about the amount, it's about the discipline, and it's about the time aspect. The earlier you start investing, the earlier you get disciplined. And the earlier you start investing, and the earlier you start getting that benefit of compounding, right? So make sure that you start as early as possible. Amount does not matter at all. It's all about the discipline. As simple as that. So again, somewhat related to the last diagram, the power of compounding is such that, it's very slow at first and then it just shoots up. It's like we call it a snowball effect. So, creating that initial traction for the snowball or making that snowball is very difficult. But when that snowball is made, right, it keeps rolling on, rolling on, rolling on, rolling on. It's very difficult to stop it, right? So, again, to give you an example, assume that someone is investing 30,000 rupees every month, right? And he gets a 12% or he or she gets a 12% rate of return. So, it takes a painfully long 8 years to reach their first 50 lakhs. It takes only 4 years, which is half of 8 years for the second 50 lakhs. But it takes only 3 years for the third 50 lakhs. And by the time you reach the 28th year, right, you add rupees 50 lakh almost every year. So that is compounding for you, when you actually visualize it. So this is again a diagram. I think I will ask you all of you to just go through it when you get the presentation after the webinar. It basically tells you if you invest say 10,000 rupees every month and you want to reach a target of say 1 crore at 12% returns, how much time will it take you? So it will take you 20 years. Assuming that you are investing 1 lakh rupees every month and you want to reach say 4 crores at 12% return rate, how much time will it take you? It will take you 13 years. So it's just a grid diagram. You can just try to find out what's your goal and what kind of a monthly SIP you can put in, and then this diagram will basically tell you how much years it will take you. So this is a very interesting diagram. We have a concept called step up SIP in the markets. Now what happens is, of course, there is inflation which is eating your money every year. So number one way to beat it is to invest in assets that are appreciating for you. Number one is of course equity. And number two, what you can do is that, assuming that every year your salary gets increased by 10% or 20%, right? So make sure that you also step up your SIPs every year. So assuming that I'm putting 30,000 rupee SIP every month this year, I know that, okay, my salary is going to get hiked by 15%. So what I will do is that I'll also hike my SIP investments by the same quantum. So next year I'll do 33 or 34,000 rupees ka SIPs. So what happens is that, see, let's be very honest with the fact that, money makes money, right? So a 10,000 rupee SIP will take 15 years to reach 1 crore, right? But a 20,000 rupee SIP will just take 12 years, right? Or say a 30,000 rupee SIP will take you just 10 years. So the more you invest, the bigger the quantum of the returns will be, as simple as that. So make sure that, you also try to step up your SIPs if you can. So, this is an example that I have used in the previous presentation as well, and I'll use it again today. If you have a outstanding home loan with you, right? So last time I was just making these calculations for a client of mine. So assuming you have a home loan of 70 lakhs for 20 years, right? And this loan's rate of interest is 8.5%. So your EMI is close to 61,000 rupees, right? So you will pay 70 lakh rupees back in principal and close to 76 lakh rupees of interest. So total you will pay close to 1.5 crores. Now what you can do is that, you can start an SIP which is equal to 17% of the EMI amount, right? So let's say 10,000 rupees for the next 20 years. So your total corpus would be 1.52 crores, right? So what you have done is that you have basically negated the loan fully, right? Because you're getting 1.5 crores total at the end of 20 years, and you have also paid back 1.5 to 1.5 crores in the loan. So thanks to the SIP, you have negated the 100% impact of a loan on you. Of course, if you want to more than negate the impact of the loan, you can say start a SIP of 30%, right? It will be like almost 2x of the loan amount. And if you want to just negate the cost of interest for you, right, which is almost double of a loan amount, right? So in this case, it's almost like 75, 76 lakhs. So in that case, what you can do is that you can start EMI of you can start a SIP which is like equal to 8.5% of the EMI amount. So in this case, if you start a SIP of say 5,000 rupees, this will give you 76 lakh rupees after 20 years. So in this kind of a SIP, your interest cost is totally covered by the SIP. Again, when you get this presentation, you can just go through the illustrations. So, like I was alluding to earlier, right? You take the SIP figure of February 2021. So on the right hand side, top right hand side. So the SIP figure was just 7,500 crores. In January 2024, it was closer to 19,000 crores. And this month, the SIP figure has come closer to 19,300 crores, right? So the SIP figures are constantly on the move, on the up move, and a lot of people are using SIPs to create their wealth. In fact, so I'm a Marathi, right? So we have one of our Marathi investing groups, and in that, we had just gotten one message, so one person over there had invested 28 years back in a mutual fund scheme. Only 105 people today are holding on to the scheme, and he's one of them. And his wealth multiplied by 270 times. So, like you can see from my tweet, right? Wealth multiplies by staying put. And number two, not everyone has the patience to do so. So, there are crores of mutual fund portfolios in the country, but only 105 people held on to that particular mutual fund portfolio, right? Okay, of course, that time there were not crores of mutual fund portfolios, but there were tens of lakhs of mutual fund portfolios, right? So this guy who actually held on to his mutual fund for the last 28 years is like 0.00001%, right? So this is the power of SIP and this is the power of compounding, right? So just wanted to showcase that from a live example. And last, I think this is my second last slide. Okay. So when we talk about stocks, we always talk about 100 baggers, 200 baggers, 300 baggers. So to simplify it for everyone, 100, 200, 300 bagger basically means that, if you had put in 1 rupee in the stock, a 100 bagger would have turned that 1 rupee into 100 rupee. 200 bagger would have turned that 1 rupee into 200 rupee, and 300 bagger would have turned that 1 rupee into 300 rupees. So it's a very big deal, getting a 100 or a 200 or a 300 bagger. And as you can see from Gurmeet sir's tweet from here, that there are 11 mutual fund schemes which have become 100 baggers plus, right? Some of them have even multiplied your money by 200 and 300 times. So again, you can see the launch dates, right? It's 1995, 2002. So last 2.5 decades, if you would have stayed put onto your mutual fund schemes, you would have made a hell lot of money. This slide is always a part of my presentation because it will basically tell you in the last 34, 35 years, there have been minimum 60 to 70 instances when people said that the world is going to end, right? But it has never happened. In fact, all of those times were really good or very profitable times to get into the market because you would have made a lot of money. So same during COVID, same during the Israel-Hamas war, the tensions that arose during the Russia-Ukraine crisis. So a lot of events from here. I'll just read a few of them. So you had the Kargil war, you had the dot-com bubble, you have the Ketan Parekh scandal, you have the great financial crisis, 26/11 Mumbai attacks. You had the Brexit, you had RERA, you had GST, you had IL&FS crisis, you had long-term LTCG coming in 2018 budget. Right. But still see, where the markets have reached. The markets have reached 75,000 despite all of these events. So all of these events are speed breakers at best. So the reason for showing this diagram is to tell you that, a lot of adverse events keep happening. It has happened in the past, they are happening, and it will keep happening in the future as well. So use an SIP so that you don't get emotionally swayed, you don't get scared. And SIP is that discipline which will make sure that whatever is happening in the market, it doesn't really matter to you because you are investing through an automated approach. So equity markets do witness a 10 to 20% temporary decline almost every year, right? So despite the markets having intra-year declines every year, 35 out of 44 years have ended with positive returns. So in the equity markets, we have a very famous saying, there is no return without risk, as simple as that. See, the reason why some people put their money in FD or LIC is because they want their money back. They can't take 1% of risk. But when you put it into the equity markets, you are taking some risk in the form of volatility. That right? Markets are not a straight line up. It is up, down, up, down, up, down, up, down. But in the long run, the markets are still going up, right? So when you're investing via an SIP, make sure that you know what you're getting into. So number one is that, of course, the markets are full of ups and downs. So make sure that when there's a big market down move, make sure to monetize on it, right? Or just stay put. Don't panic and press the sell button. Just stay put. So again, temporary market declines of 30-60% has also happened once every 7 to 10 years. So not a all of this is very normal for the market. It's nothing new. So I think that's about it, guys. I will take questions now.
Aditya, some questions have been posted in the Q&A
Oh,
session
yes.
also.
Yeah. Okay, perfect. So, guys, number one, please post your questions in the Q&A tab. So Bhavani Saha has a question: how can a beginner start investing in SIPs? Kindly provide with the step-by-step procedure to proceed. So the thing is, Bhavani, what you can also do is that uh, you can choose a simple index fund. You can invest in, say, a Nifty 50, Nifty Next 50. If you are young and you can take a lot of risks, right? So you can maybe get into mutual funds such as Kotak Emerging Equity, Tata Large and Mid Cap, SBI Contra. So what we usually suggest is that you can have a mutual fund portfolio of around 3 to 5 funds. So assuming you have 30,000 rupees to invest every month, what you can do is that you can divide it into 5 funds. You can put 6,000 each into the 5 funds, and you can start your SIPs. And like I said, make sure that you continue these SIPs for a minimum of 10 years. So Fulwar Singh has an interesting question. In case of lump sum funds received to be invested by way SIP through STP, by keeping the amount in liquid fund, what should be minimum period of SIP to take advantage of averaging cost? So Fulwar Singh, I think this is something that I just answered right now. Make sure that you invest for a minimum of 7 to 10 years. So assuming that that all right, I'm getting, say, 12 lakh rupees this year, and then I will again get say 12 lakh rupees after 4 or 5 years. So make sure that this 12 lakh rupees you're dividing across 3 years, or you're dividing it across 2 years. One more thing, what you can do over here is that you can one shot deploy 40 to 50% of the money, and the rest can be deployed in a SIP kind of a manner. Navarun has a question: what is meant by rupee cost averaging? Navarun, the answer is very simple. It basically means that you're averaging your cost. So assuming that you invest in a mutual fund when the NAV is rupees 10 this month, and you invest in the same mutual fund when its NAV goes to, say, 9 rupee next month, your average cost comes out to be 9.5 rupees. So you're basically averaging that cost over a very long period of time or over a very short period of time. So Pratap Kumar Das has a very interesting question. Can daily SIP make any difference over monthly SIP? So Pratap ji, इसमें कैसा है कि there's not a very large difference, honestly. नंबर वन, आप मंथली करो, क्वार्टरली करो, मंथली एंड डेली में बहुत ज्यादा डिफरेंस नहीं है, बिकॉज आई वाज जस्ट लुकिंग एट दिस डेटा फ्रॉम वन एएमसी recently. So my sense is to do it monthly, because the number of transactions also will be lesser, and it will be less operational hassle for you as well. So do a monthly SIP. So best way to hold your mutual funds, SOA or DMAT, I think it depends from person to person. Some people like to have it in DMAT, some people like to have it in the folio format. So anything. So how can I join a financial literacy awareness campaign and make some secondary income too, as I'm near my superannuation? Uh, I think what you can do, sir, over here is, unfortunately, there's no name. Is that you can try to educate yourself, and since you said that you're nearing your retirement, right? So so you're in the income preservation and the income withdrawal stage, right? So you're not in the uh, say the corpus growing stage. So make sure that you keep that corpus very steady, and you try to withdraw from it. Please explain bagger. So like I said, a 10 bagger is a company that multiplies your wealth by 10 times. So if you had put in 1 rupee, it would be 10 rupee. If it's 100 bagger, it's like 1 rupee is becoming 100 rupees, right? So a bagger basically means a multiple, as simple as that. Can we do SIP in stocks directly as same as MF? I think this is a brilliant question. Yes, a lot of people do SIPs in direct stocks as well, and you can definitely do it. I mean, there's no harm in it, honestly. What is the best platform to invest in SIP? See, there's no best platform as such for SIPs. You can buy from the AMC, you can buy from distributors like us, you can use apps like Grow or Zerodha. There are multiple ways to actually invest in the markets or in SIPs. So what is the right time for SIP? So like I explained before, there is no right time for the SIP. If you want, you can invest this month, you can invest next month, you can pick any random date that you like, right? And the result is almost going to be same. You pick any month, you pick any day, right? So there is no end difference as such. Uh, 1 second. Step up SIP, Vijay, great question. So what I had spoken about, and I'll repeat myself. See, there are two things to this, Vijay. See, number one, why are you trying to invest? Because to beat inflation, right? And what's happening is that, see, your lifestyle is also changing every year. Your income is also changing every year, and hopefully it's on the positive side. So assuming that you're investing 30,000 rupees each month this year after all your needs and wants, uh, and you get a 10% salary hike or a 20% salary hike. So what you can do then is that you can also hike up your SIP by the same quantum. So this will ensure that you end up with a higher quantum of returns in the end, right? And it will also ensure that you reach your goal earlier. So Vijay, what I will do is I'll just show this visually to you as well, because I think this will set a lot of context for you. So if you see over here, Vijay, I'll dictate it for you. Uh, Second. Yeah. So assuming that Vijay, you're investing 30,000 rupees every month and you want to reach a target of 1 year, 1 crore, you know, uh, with no annual step up or no annual increase in SIP amount, it will take you 12 years and 4 months. But if you hike up your SIP by 10% every year, it will take you just 10 years. So hiking up your SIPs is a good way to actually reach your goal earlier, as simple as that. So can a person living and earning overseas invest in mutual fund in India? Definitely yes. For beginners, what is the right fund? Nifty 50 is good, Nifty 150, Nifty 500, Nifty 200, Nifty next 50. See, if you don't have the time to research actively managed mutual funds, you can always go for passive mutual fund. There's no harm in it. Nifty 50 itself has given you a CAGR of 14.5% in the last 25, 28 years, right? So you can do that. So Chetan has asked an interesting question, where I'm getting the slides from. Uh, so I have used two major resources in this. Number one is the Funds India research report, which comes every month. So it's called Wealth Conversations. And number two, I have used a few slides from the White Oak mutual fund SIP presentation as well. And of course, a lot of other data that you see is my own research. For example, the example that I gave you for 200, 300 baggers, all of it we have compiled ourselves and presented here. So Amit has an interesting question: how Grow Direct Plan is different from AMC website direct plan. So Amit, honestly speaking, I haven't used Grow. I use our own platform, my own company's platform. But I'm sure that Grow also has some component of their charges embedded in it, right? Because or else the platform is not sustainable at all, right? They also have to take care of their cost in the end. So Rohit Rai has a question: is it advisable to invest in index funds for mid and small cap, or should we go with active funds? So Rohit, this question has to be answered by you yourself, honestly speaking, because it number one, it depends on your age, your risk appetite, and the kind of returns that you expect. So a large and mid cap will give you 15% CAGR. A small and mid cap can maybe give you 17%, 18% CAGR, right? So you have to do a mix of all of these funds and then try to just calculate what kind of return you want as per your goals, and then try to fit in all of these pieces together. So again, Nikhil, I have answered your question, mid cap, small cap, or Nifty mutual fund, which one is better? It has to be decided by you, honestly. So what is the difference between CAGR and absolute return? So CAGR basically tells you, the compounded annual growth rate. So for example, for Nifty, we saw that the CAGR was close to 15% or 14.5%. It basically means that, for a 10-year period, the return of Nifty was close to, say, 170, 180%, because every year we were getting 14.5%. So, like I said, the absolute return over here was 180 to 170 to 180%, but the CAGR was 14.5%. So, which fund is good for long term? 10 years plus, small cap, flexi cap, or SIP? For SIP, yeah, I think you can do both. In fact, you can do a flexi cap, you can do a large and mid cap, you can even do a small cap. See, guys, the thing is, to give you a food analogy, right? Uh, we can eat dal chawal, we can eat a pizza, we can eat a burger, right? We can eat anything, right? But the question is, what actually suits you and what is the end goal, right? So you have a lot of instruments at your disposal. You have a lot of segmentation of funds at your disposal, and then you have to choose it as per your risk appetite. And again, like I said, if like I have dropped in my credentials, I have dropped in my email ID, I have dropped in my number as well. If someone wants a consultation on this, I'm free to do that as well. So Sheikh has a very interesting question. He's asking a SIP investment on banking sector or a SIP on MNCs. So what happens in mutual funds is that you have particular thematic mutual funds as well. So you would have a banking and financial services fund, you would have a healthcare fund, you would have a consumption fund. So depending on the kind of research that you have done and depending on the kind of conviction that you have, you can also choose thematic funds. But we personally don't advise for it, because see, again, then you have to bring about a lot of activity to it, right? So for example, we suggest thematic funds to our clients, right? For example, after COVID, we had suggested focused funds to our clients. Now focused funds were a very the top 50% of the portfolio was made up of banking and financial services and IT, which was going through a bad phase, and we knew that, okay, in the next 1 to 2 years both of these sectors will do well. So in that case, when you have a particular mindset or a conviction on a particular sector, you can definitely choose a thematic fund, no problem. So Nitesh has a interesting question. He's asking, what is the index fund in mutual fund? So Mr. Nitesh, the thing is, India has a lot of indices. We have Nifty 50, we have Nifty Next 50, we have Nifty 150. So index fund is basically that only, right? Index is a passively managed fund wherein companies come in, companies go out. So one more anonymous person has asked, they are going to start earning, and if they invest 2 to 5,000 rupees every month, is it okay? So definitely okay. Like I said earlier, when I also started earning, I did not really care about the amount. I just started investing that amount every month because I wanted to instill that discipline. And mind you, after 10, 11 years, the benefit that you get from this small or the big investments is very huge. So what are the parameters to select a mutual fund? So number one, just check what the category has returned or what the category has given you in terms of returns. Number two, just check the fund manager and the style. And number three, you can just check the churn, how many times the mutual fund portfolio manager has sold and bought the portfolio. Now, very interestingly, we were just studying one fund which said that, they are a long-term fund, right? And the 1 year churn for that mutual fund was 200%, which means that, they have bought the whole portfolio, they have sold the whole portfolio, they have bought again the whole portfolio, they have again sold the whole portfolio, and they have again bought the whole portfolio. So if they have churned the entire portfolio 2 times, right? So they can't be long-term funds. So make sure that these 3, 4 parameters you check while investing. And since someone is asking for my credentials again, I'm just okay. As a student, which will be the best fund to invest in? As a student, I don't have time to do my own research. So, Nifty 50, Nifty Next 50, Kotak Emerging Equity, SBI Contra, Mahindra Manulife Multicap, some of the good funds that you can invest in, right? So this is a mixture of index fund. It's a mixture of large cap funds. It's a mixture of 1 to 2 funds which will take a bit some amount of risk for you, right? So it's a balanced portfolio for you. So Gunjan Jandir has an interesting question. How does compounding actually come into play for mutual funds? How does this compounding happen? So Gunjan is very simple. You buy into a share, you hold on to it for very long, right? So what happens is that money starts making money. See, when we talk about Nifty's return for the past 20, 25, 28 years, right? Is it's 14 and a half, 15%. When you talk about it, it's not very huge. But when you talk about it in absolute numbers, it's like 73 times over the past 30 years, right? So that's a very huge number. So whenever you invest in mutual funds, make sure that आप अपनी SIP चालू रखो for a very long period of time. Don't stop them in between just because of panic. And definitely we'll see compounding for sure. See, I have seen it personally, both in direct equity and mutual funds, and that's why I propagate this to everybody. See, like we saw in the example, right? The first 8 years are very difficult. You may not really get to see a lot of big benefits. But after 10 years, the benefits are definitely tangible and are definitely huge. Again, I speak all of this from my personal experience. So Birju Kumar has an interesting question. If I invest in SIP, a monthly SIP, but I fail to invest in monthly SIP, then what is the solution? See, Birju ji, what you can do then is that, you can on your own uh, try to invest every month, because the people who don't have a regular income, getting into an SIP for them would be a bit of a challenge, because some AMCs have a cool down period before which you can't really stop your SIPs or pause your SIPs. And if the amount is not there, then they will deduct a small penalty also, like 1,500 rupees. Right. So there are two solutions for you. Number one, what you can do is that you can put all of a lump sum corpus in a liquid fund, and every month or every quarter when you want to invest, you can just put a STP from surplus fund to a equity fund, from the liquid fund to the equity fund. So Pradeep ji has an interesting question. I have 1 year left on a housing loan. I can currently repay the loan due to sale of another asset. Is it better to pay off the loan or invest in an MF and do a SWP? See, since you have just 1 year of loan left, I think it's much better to pay it off. See, there are two things in this again. That SIP plus EMI combination that I was showing you guys, there are two ways to look at it. Number one, you continue the EMI, and at the same time you start a SIP to negate the impact of the loan. Or what you can do is that you can pay off a huge part of the loan, or you can just pay off the loan. The tax benefits will go, of course, right? And it depends on your regime, old or new. And what you can do then is that with that increased surplus that you have in your hands, you can invest in SIPs. So in both the scenarios, you try to negate the impact of the EMI, right? So in the first case, you start a SIP in front of it so that you have negated the cost of it. And in the second one, since you have the cash with you, you try to pay off the loan as quickly as possible. And then with the extra surplus that you have by not paying the EMI every month, you can invest more in SIPs, right? So the impact majorly, more or less, will be the same. So Abhinav has an interesting question, and I'll take this as the second last question. I have been doing SIPs for the past 5 years, and now the portfolio value has reached a big amount, and now SIPs are not averaging the PF much. So how do we manage the same as we're exposed to portfolio ups and downs without much protection? So Abhinav ji, see, again, ups and downs are a part of the portfolio, and this is all prima facie. I haven't really seen your portfolio, so I can't comment much on the kind of funds that you may have and the kind of portfolio construct that you may have. But you're absolutely right. After a point of time when the portfolio becomes very big, your monthly SIP amount is like just like a drop in the ocean, right? But still continue with your SIPs. Again, this is all prima facie, as I haven't seen your portfolio. Okay, wow. I think this question I have to take for sure. So Mandaji has said that my husband has invested in SIP through an LIC agent. Every month, rupees 5,000 is deducted from his bank account. Almost 10 years are over now, and where to get the information about how much SIP has earned him, and secondly, how to invest in SIP of our own. So Mandaji, number one, please call that agent today and please ask him for your account statement. Sir, account statement of mutual fund will come like a proper bank statement wherein all your SIPs will be listed. So 10 years, right? So from April 2014 to April 2024, whatever SIPs have gotten detected, it will be shown over there, and your profit and loss will be also shown there. So, Mandaji, if you're hearing this, please contact your agent right away, because 10 years have passed by, and if he or she hasn't given you anything, then it is a very serious issue and you have to get it. And how to invest in SIP of our own? See, there are two ways. Number one, you can directly buy an index fund, or number two, you can go to distributors uh, like us, and then ask them. You can tell us that, okay, this is my age, this is my risk appetite, these are my goals in life, this is where I'm standing today, this is where I want to be in the next 15, 20 years, right? And the distributor or the financial advisor will actually chart out a plan for you, right? So a very simple illustration I'll give you for that, Mandaji. So you assuming that you call me and you say that, okay, Aditya, I'm at 1 crore today, and I want to reach say 2 crores in the next 7 years, right? So it's very simple. What you have to do is you have to invest in equities. You require a rate of return of anywhere from 11.5 to 12% every year, and you can easily reach that goal in the next 7 years. Of course, this what I have just told you is a gross simplification, but this is how this calculation is actually done. So, Rajalakshmi ma'am, I think that I have taken as the last question. So if you just
All
want
right.
to give out any, I can
Okay.
see a lot of questions still, but yeah.
Right, right. But yes, thank you so much, Aditya, for sharing your expertise on such an important topic and patiently taking up so many queries. Also, I want to thank each and every one of you audience for your active participation and such thoughtful questions. So till we meet next time we'll definitely meet, to add up further on this particular knowledge session. So till then, have a very good evening. Thank you
Good,
all, and thank
good
you,
evening
Aditya.
to everyone, and thank you so much for patient listening and so many pointed questions. Thank you.